Assalamu alaikum. I'm Irfan Mansoor and you're watching my channel, The Accountants Academy. Students, now you're watching part 2 of the lecture that we have already started previously as the principle of accounting, and was the first chapter that we had started was accounting definition and started terminologies, where we have learned about fixed assets, about its classification and its recognition criteria. We will continue our same lecture after fixed assets, and I will brief you about all the lessons. One thing that I would like to bring in your knowledge, that soon I will upload these two video lectures also in Urdu language, inshallah. Here we go. Our today's topic. First of all, I would like to mention you here that we have already discussed assets and type of assets in our past lecture, part 1, and today we will discuss about liabilities and types of liabilities, capital, expenses, their classification, the kinds, revenue, along with all these terminologies, recognition criteria, and accounting treatment. Definition of liabilities. A liability is something owed to the business in terms of any undertaking or something bought or recognized as obligation to pay for something. The recognition criteria for the liabilities is when the transaction has realized, goods or services delivered or undertaken to deliver rather than they are paid. It is very important. You must remember that the recognition point of liability is where the goods or services are delivered or undertaken to deliver rather than at the time when cash or cash equivalent is being paid. Liabilities are of two types. Number 1, current liabilities. Number 2, long-term liabilities. Current liabilities are generally payable within one accounting period. Current liabilities incurs as a result of normal course of business expenditure and it's part of operating cycle. Current maturities of long-term debts, interest payable on outstanding debts including long-term obligations, income taxes owed with the next year. Here you will notice that 1, 2, 3, all 3 points they are explaining about the current liabilities, what they are, and further for long-term liabilities They generally incurs as a result of obtaining long-term resources. Definitely, sometime business requires massive investments. They approach to the intermediaries, to banks, to financial institutions, and they gather their funds and introduce into the business. Basically, such sort of liabilities incurs for long-term purpose, for bigger projects, and for capital expenditures. There are various forms: running finance, finance lease, pledges, mortgages, and we will discuss later in our advanced studies. Number two, long-term liabilities will not fall due within one accounting period. Yes, this is the criteria, and you should beware of it while having transaction, while you are recording the transaction, that it is short-term liability or it is long-term liability. If you will remember the criteria by which the classification can be, you can say, transactions can be classified as short-term or long-term or current liabilities or long-term liabilities, it will be easier for you. Number three, the current proportion of long-term debt listed separately to provide a more accurate view of a company's current liquidity. Remember, the current proportion that is going to fall due for the year will be recognized as current liabilities, and it should be classified as long-term liabilities proportion falling due within the year, so that the liquidity of the organization can be assessed, so that you can say an organization can see that whether it has enough funds to pay off its liabilities or not. Now, the criteria, definitely it is very important thing to remember. Once you will understand all these criterias, their recognitions, their classifications, it will be far more easier for you to understand the transaction and to score biggest marks in your examinations. Now, recognition criteria. A liability is recognized in the balance sheet when it is possible that an outflow of resource representing economic benefit will result from the settlement of a present obligation, and the amount at which the settlement will take place can be measured reliably. It is very simple. For revision purpose, once again, financial obligations that are due within one accounting year or within a normal operating cycle is current liability, and long-term liabilities are for long-term more than one accounting period. Definition of an expense. Expenditure is an outflow of money from one entity to another against any short or long-term benefit to generate revenue. Recognition. When the transaction has been realized, goods or services are delivered or undertaken to deliver rather than they are paid in cash or cash equivalents. Expenditures are of two types: revenue expenditures and capital expenditure. Revenue expenditures generally incurs as a part of business operation or to run the operation. Revenue expenditure incurs for short-term period and classified as nominal accounts. And one thing you should aware of it, that an expenditure that incurs continuously within the accounting period means the benefit that is derived from the expense is for short term and it requires a recurrence frequently. It means that it's revenue expenditure. Recognition criteria is temporary expense may incur repeatedly for the purpose to derive revenue. Capital expenditures. Capital expenditures it incurs for more than one accounting period and is capitalized by recognizing as non-current assets. Here you will notice that capital expenditures are recognized, recorded, realized as the way fixed assets are recognized and realized. Means capital expenditures are recognized as the non-current assets. It incurs for a long-term period, for a long-term purpose, generally for more than one accounting period. Once again, recognition. Recognition criteria that results in the expansion of the capabilities, performance or technological upgradation, or in result of useful life extended. If any of the below mentioned criteria matches to the scenario, then it should be recognized as fixed assets or as capital expenditure. Once again, revenue expenditures are for short term, less than one accounting period, or temporary or may incur frequently. For capital expenditure are for long term, more than one accounting period, are recorded as fixed assets, are capitalized as fixed assets. These expenses are revenue expenditures. These expenditures are recognized as expense and written off against profit and loss account. This is the treatment. And in the case of capital expenditure, any major expenditure that incurs, such as major overhauling of property, plant, equipment, and other things, or the criteria that is mentioned above in number 3 of capital expenditure, it should be recognized, realized as an asset, as a non-current asset. And now, our second last terminology is capital. Students, you can identify capital, or you can understand better capital by the above given equation. Assets minus liabilities is equals to owner's equity. Means assets are the resources that is provided by the owner of the business to the business to use as resource. Though there are two types of sources that provides resources to an organization or an entity. Number one, definitely that is owner. If owner brings resources from his personal resources, definitely that is the source known as capital or owner's equity. And liabilities, definitely liability is another source that provides assets or resource to the business to use in the business, like financing from banking institutions, acquisition of fixed assets on credit, purchases of raw materials, finished goods, merchandise. All these are resources that is provided by the owner as source either from his investment or from liability. To differentiate here, you can see assets are being resources of the business for the purpose to operate the business. On the other hand, there are two sources out of one source, means total resources, the combination of assets and liabilities. If you deduct one source, that is liability, you will have remaining one source, that is capital. Once again, I will repeat here, liabilities are owed to the business and the business has an obligation to pay it off. Liabilities are source that provide resource to the business, but these resources ought to be paid off. This is the obligation of the business. And now further, the owner's equity. Owner's equity is the source by which the owner or owners of the business provide resources to the business, and these are the owner's own resources or known as the investment by the owner, and these are the belongings of the owner. Owner took the risk and he invests in the business, and as a reward he earns profit. And here we go. This is our final slide of our continued lecture. Students, the last element is revenue. A revenue can be defined as revenue is any monetary inflow of an entity. This is the simplest example. This is the simplest definition. Now, there are two classifications of revenue. Number one, that is direct revenue. Direct revenues are any economic monetary inflow driven from the operating activity of an entity. Means, if an entity is doing business of manufacturing and manufacturing of accessories, its principal operating activity of the business is to manufacture the accessories. Whereas the second definition of second classification is an economic monetary inflow driven by the other than normal course of business activity of an entity. Means a revenue that is driven from any other activity of the business. Means in our example in that is mentioned here for direct revenue, that a business principal activity or operating activity was a business having operating activity of manufacturing accessories. But in manufacturing of accessories, there are some wastes, there are some scrap after usage, then the business sold it out. Definitely this is can easily observe here that the business objective, the business operating activity was not to sell scrap or damaged goods. This is the second criteria. Students, revenue recognition and revenue criteria are outlined by IAS 18, accounting for revenues. And here we will see some important outlines, guidance from IAS that cannot be ignored while studying about revenue. IAS 18 outlines the accounting requirement for when to recognize revenue from the sale of goods, rendering of services, or for interest, royalties and dividends. These are the various sources from which we derive our revenue. Revenue is measured at the fair value of the consideration received or receivable and recognized when prescribed conditions are met. Definitely there are some criteria. The criteria means when you have got an order, you will have to prepare the order, you will have to dispatch the order. Once you dispatch the order and your customer accepts a good, now it is realized that the revenue is now recognized and it is you can say probable that revenue will flow into the entity. Which depends the nature of the revenue. Definitely there are various conditions. This will be discussed in our later studies. Recognition criteria of IAS 18, accounting for revenue, is it is probable that any future economic benefit associated with the item of revenue will flow to the entity, and the amount of revenue can be measured reliably. Once you can reliably measure the amount of the revenue, then it is probable that you can record the revenue and it is realized and recognized. It can be disclosed into the financial statements. I hope these explanations, these terminologies, their criterias will be easier to you to understand, and I hope that this will be beneficial for you, and I will request you to please like, subscribe and share these videos. We will meet inshallah with another lecture. Thank you very much. Bye bye.